Hey, what's up, stock compounders? Brad here. So it is the Saturday Q&A, which is awesome. I love doing these. I pulled a handful of questions off of the Facebook Value Investing group, which is an open group to the public. There's over 100,000 people in this group, so check it out. So the first question, let's jump right in. What do you think are the most important words to learn when it comes to investing? Well, a few that come to mind right away: patience. Okay, patience it's really a game changer with investing. The people who are impatient don't get very far, to be quite honest. It takes patience to allow the compound growth engine that is proper stock investing do its thing, do its exponential growth thing. So patience is absolutely critical. What else? So moat, companies that have a durable competitive advantage, for whatever reason. It's so good for your portfolio if you can find companies that are able to grow market share over time, kind of fend off the competition. It's just fabulous if you can park your money in a business that can do that. So patience, moat. One of the things I really like that I heard from Monish Pabrai was this little catchphrase: big bets, infrequent bets. Okay, big bets. So it's rare. It doesn't happen very often to find a great investment opportunity, but when you find it, it's important to have the courage, have the confidence to bet big on that opportunity. So Pabrai, he likes to put 10% of his investment fund into any given opportunity. He doesn't exceed 10% in his fund, but that's a great opportunity for him. He loves to go in at 10%, which means if he has 10% and he's fully invested, ideally he wants to own about 10 businesses. Big bets, infrequent bets. So the infrequent bet piece is, there's just in anyone's circle of competence within the realm of businesses that any single person is capable of understanding. It's not that often that an opportunity comes up that smacks you over the head and says, okay, this is a great opportunity. So that's the infrequent part. They just don't come by very often. And so that's, again, pointing to the patience. It's important to have the patience to wait, let the cash pile up. If you're investing, if you're putting money into your portfolio each week or each month, let it pile up until there's an opportunity, an infrequent opportunity that comes along that's worth putting a big bet on. So those are some of and of course, return on invested capital. Learn that, because that really points to these companies with a durable competitive advantage that are they work wonders for your investment portfolio over time. So that's the first question. Second question: I'm getting my son into investing at age 19. Our brokerage offers slices of stocks, what I call fractional shares. Should I lean him towards slices or buy full shares of cheaper companies? So, his son, say he's got $100 to start with or something like that. With $100, you're not going to be able to buy full shares of company like Apple or Amazon or, not that I'm recommending those companies. I think those are really expensive right now. But, there's a lot of companies whose share price is higher than $100. So the question is, should I direct him towards buying fractional shares of those businesses, or just target companies where the share price, the stock price is below $20 or whatever the threshold is. So I don't see any problem with owning fractional shares. Even if you have $20 to invest, okay, and you're going to put $5 into a business that has, $200 share price, I don't see any problem with that, because shares, they're really just fractional ownerships of a business anyway. A share is a partial ownership of a business. So what's the problem with subdividing those individual shares? I don't see any issue with that at all. So to this question, I would say, don't limit yourself to, companies that you can only companies that you can afford to buy a full share of. That just doesn't make any sense to me. So, I would highly recommend keep that whole universe of stocks open, filter in other ways than just filtering by low share price. And I don't see any issue with buying fractional shares. Let me know if you have a different take on that. I'm certainly open to learning, why there might be a downside to fractional shares, but I don't see any. So that's my answer to that one. Number 3, are there any true bargains in the market right now with a 5 to 10 year time horizon? Now, obviously, the person who asked this question is just looking for stock tips. There are always bargains somewhere in the market. Now, any individual, like I said before, is only going to understand a small fraction of companies in the market. Say there are, I don't know what it is now, 3,500 public companies in the US. Like any given individual certainly isn't going to understand more than like 5%. That's on the high end of those businesses. So sure, there are true bargains in the market right now, but if I identify a company as a true bargain and you don't understand that business, I mean, okay, so maybe you'll buy into it at a bargain price, but how are you going to know when to sell if you don't understand the business, right? So there are always true bargains. I don't recommend taking stock tips from other people on what the true bargains are. It's only a true bargain if you understand the business well enough to be able to identify it yourself as a true bargain. Okay, so this question, I mean, I get that this person just wants stock tips, but true bargains are really in the eye of the beholder, and that eye needs to have the proper skills to assess whether it's actually a bargain or whether, it's just window dressed as a bargain. So that's my answer to number 3. Number 4, my goal is to invest for the long run. I'm starting with $10,000 and I want to add at least $1,000 per month. Should I automatically add the $1,000 every month, or should I put the money aside and wait for the right opportunities? Well, there's a lot of different approaches, a lot of different answers to this question. My personal approach, well, there's kind of two ways. Two ways that I'll talk about. One is if you're just investing in an index fund like VOO or another fund that tracks a market like the S&P 500. To me, it makes sense to kind of mechanically invest the same amount, each period of time. So say if you're investing $1,000 a month, put $1,000 into VOO or whatever index fund you're using every month, because it's really hard to time the market. Okay, I think there's a lot more people who fail trying to time the market than people who actually succeed and gain an edge by timing the market. So, if you're doing it in a more passive way, like an index fund, do it automatically. leave the timing element out of it. Now, if you're investing in individual stocks, like I do, basically what I'm doing is I'm letting I deposit money every month into my account, and I'm not going to invest it unless there's a compelling opportunity to invest it. So I will let it pile up, and when a stock on my watch list hits my buy price or goes lower than my buy price, that's when I'm going to start buying into that stock. Okay, so in that situation, I'm waiting for the right opportunity. I'm waiting for the price of one of these companies on my list to drop significantly below the value that I've ascertained for that share of stock, and that's when I'll start buying into it. So, if you don't have the skill set to be picking individual stocks, don't try to time the market. I don't try to time the market. I'm really just waiting for the margin of safety to show up with a stock on my list, a company that I understand. Okay, so that's how I'll answer that one. Number 5, with the seemingly ever expanding supply of dollars, are you worried about the possibility of a dollar crash? Okay. If so, how are you hedging? What are you investing in to protect yourself against a dollar crash? I'm not particularly worried about the possibility of a dollar crash. The US dollar is the reserve currency of the world. Okay, the US dollar is the strongest currency in the world. It is concerning the rate at which the Fed is printing dollars to kind of deal with the issues we're facing in the US right now. Certainly, I'm sure countries that own a lot of US debt are very disturbed by the rate at which we're printing money, because the value of that debt drops as the US prints money. Ray Dalio talks about how we're kind of approaching the end of a long-term debt cycle, and how, coinciding with that, there are countries that the power structure of countries in the world can shift as that long-term debt cycle completes. So, it'll be really interesting to see what happens with the US dollar, how other countries treat the US dollar. Maybe the US dollar falls from becoming, it's not the global currency anymore. That's possible. I don't know what that looks like if that happens. But in the short term, I'm not worried about the possibility of a dollar crash. I think it's important to educate yourself about what that might look like if we do print too much money and kind of upset that balance, that global kind of economic balance. Because certainly there must be a point where other countries aren't going to tolerate how much money we're printing. They're just going to say, okay, the US dollar is no longer our reserve currency. So I don't know how long that takes to unwind something like that. I'm sure if you look back in history, there are examples of that happening. I'm just not aware of it. And I don't really plan on kind of diving into that. It doesn't quite seem real yet. We printed a lot of money back in 2008, and since then with our quantitative easing, and it hasn't really affected inflation. There may be other factors for that where it's different this time. Maybe it's worse this time. I just don't know that much about it, but it's an interesting question, and I'm sure I will continue to educate myself on what it means, what the ramifications are of how much money we're printing to try to solve kind of the economic issues that the U.S. is facing. So I'm not hedging. I'm just trying to find great businesses that are selling at a discount to value, and kind of tapping into the compound growth engine of the stock market. That's kind of my approach. Number 6 and last question. Should I take the Columbia Business School Value Investing online course? It's $3,750 and done over 8 weeks. Now, this isn't a promotion. I'm not promoting this course. This was a question I saw on the value investing group, and I thought it was interesting. Or would I be better off studying the book Security Analysis and then The Intelligent Investor, both by Benjamin Graham? So I think learning value investing properly, learning how to value a business, is incredibly valuable. And it really comes down to, how do you learn? Can you learn by reading, studying books like Security Analysis and The Intelligent Investor? Or do you learn better by being in a classroom setting where you're given homework assignments and quizzes and tests? You can interact with other students in the class. So, I look at the $3,750 figure, and that doesn't scare me at all. It's really a question of, how do you learn? What is the best format for you to learn value investing in? Personally, Aswath Damodaran is a valuation professor at NYU Stern. He's known as the Dean of Business Valuation. And he puts out, I feel like, multiple videos a week on his YouTube channel, if you just search Aswath Damodaran. And, that's how I prefer to learn valuation. I took an online course from him, but I'm learning just as much through his videos as he's valuing specific companies. So, part of the issue I have with taking a course is that, a lot of people, they take a course, just to get the grades or to get the certificate at the end. I think if you're driven enough to get the most out of a course, to go through the assignments and exercises because you're passionate about the subject, I think for those people, you might be just as well off by going through Damodaran's videos and all of the other great content that's out there on YouTube. Reading 10Ks, reading annual reports on specific businesses, looking at Dataroma to see what the great investors have bought recently, and then try to kind of deconstruct why they bought that business, what they saw in that business that made it a compelling investment to them. That's kind of how Monish Pabrai does it. He's always looking at 13Fs, what great investors are buying, and then he's trying to deconstruct what the investor sees in that business by reading about the business, reading the annual reports and write-ups on Value Investors Club. And he gets sent a lot of write-ups because he's Monish Pabrai and everybody knows who he is. And there's just so many resources. So I don't think it's necessary to take an online course to properly learn business valuation. But again, it comes down to what kind of learner you are and how you learn best. So that's what I'll say about that one. And that's all I got, guys. Saturday question and answer. Stock compounder Brad here. I hope you enjoy these Q&As. Leave a thumbs up if you do. And I will see you guys in the next video. Take care.